Welcome to the committee's annual evidence session with the Governor of the Bank of England, and we're delighted to welcome Andrew Bailey, the Governor, today. Thank you very much for your time. I should say that this is being broadcast on Parliament Live TV. A full transcript will be taken and we'll make it available shortly afterwards so that any corrections can be made. Can I start with a question about the geopolitical moment that we're in and the effect on the UK as you see it? So current forecasts clearly already point to modest growth. There is heightened geopolitical uncertainty at the moment, changing by the day it seems. Yes. Could you give us a sense of what your concerns are about the UK economic outlook as affected by those geopolitical movements?
Well, I mean, it's interesting. So I was reflecting actually before we came in that if we'd been having this hearing 24 hours ago, I'd have probably told you a somewhat different story to the one I tell you now, because we've just seen overnight quite a big change in the situation, which I've got to say honestly, I don't think I would have certainly predicted necessarily. And that's a good way of saying that, we often get quite preoccupied by sort of lexical language in the MPC that, we for a long time used the word uncertainty. We've actually introduced unpredictability as well, and there is an important difference there that, the way I look at it, uncertainty is a sort of a situation where you can use the past as some guide, but there's some varyingly large degree of sort of range of possible outcomes. Unpredictability is where you really just can't use the past. The past doesn't really provide you with much of a guide, and I think that is certainly the way we would look at the situation on trade and tariffs at the moment. And as I was saying, I mean, we've seen so far anyway, rather a big turnaround overnight in terms of the situation, certainly with for instance, with the oil price. Now, if you sort of step back from that for a moment, I'll say two things to open up. First of all, just focusing on the sort of the tariff issue for a moment. First of all, it is very unpredictable where this is all going to end up. Clearly, we're coming towards the end of the 90-day period that President Trump set out for sort of reaching agreements. I mean, we have one agreement so far, which is with the UK. It isn't obviously implemented yet. That's it at the moment. So quite where this is going to go to, I'm afraid, we don't know at this stage. So that's one reflection on it. Stepping back sort of to the sort of the economics of that side of things, fragmenting the world economy is bad for activity and bad for growth in the world economy. Now, there is a sort of balance here in the current situation, because obviously we've seen in recent years what can be also the negative effects of disruption to supply chains. So it's not the only source of disruption, but fragmenting the world economy is it's bad for activity, it's bad for productivity growth, it's bad for spreading, it's bad trade, without as much trade, it's bad for spreading innovation, for instance. The effect on inflation is much more ambiguous, frankly. It depends what the consequences are and over what time. So if, for instance, the imposition of tariffs were to lead to the redirection of exports from, let's say, China to other countries, including the UK, that could have a downward effect, or that could have a disinflationary effect. If, on the other hand, the effect is to disrupt supply chains, then that could go the other way. So it is pretty ambiguous, and the consequence of that is, and happy to come on, obviously, I'm sure we'll come on to the domestic situation. Certainly when I'm thinking about my sort of decisions on interest rates, because of the sheer unpredictability, it's not that I'm ignoring the world, I'm anything but I'm not putting that higher weight on it, because frankly it is so unpredictable at the moment that, as we saw in the last 24 hours, it can easily change overnight. And as I say, just to illustrate what we've seen in the last 24 hours, we've seen about a $10 a barrel fall in the oil price. So the West Texas price is about 65 as we speak. It was about 75 at the weekend. Obviously we'd seen it go up as the hostilities had started. But this takes us back to, I think we're now back to about sort of 5% above where we were sort of at the beginning of May, and we're actually probably a bit below where we were in February. Gas price hasn't moved much. So I must say yesterday afternoon, just to illustrate it, when I sort of first read that, Iran had fired missiles at Qatar, that sort of suggested to me that would be bad news, and then the oil price promptly went down. And we seem to be in a sort of slightly different world here, where there's sort of these sort of hostilities break out, but they're rather sort of controlled and sort of, I've sent missiles your way, will you shoot them down? And if you do, then that will be okay. I mean, it's a very different world, let me put it that way.
I mean, I guess there are different kinds of volatility is one of the lessons we learned. But could you say anything perhaps about what you've learned over the past few years about what the bank can do in times of great volatility? How do you spot the difference between markets adjusting and markets being so volatile that for stability reasons bank intervention might be needed?
Well, I think we have learnt a lot over recent years. It's a good question. So, first of all, you're right. I mean, we can have obviously, volatility which can cause financial stability problems. It can cause market stability problems. But it may not be, as prolonged as you might sort of expect to cause more sort of deeper macroeconomic problems. And I think one of the things we've learned in recent years is that we've had to expand our sort of toolkit of dealing with these things to make a clearer distinction between those two things. I mean, looking back over recent months, what I would say is that certainly sort of back in sort of April, for instance, we saw quite elevated market volatility. And there were one or two moments in particular, I would say, where I thought certainly we were looking at globally quite a difficult situation. Obviously, there were two moments at which I would say the US administration stepped back. The first one was when the 90-day tariff window came in, and the second one was over the question about Chair Powell's future at the Federal Reserve. And on both occasions, obviously, things got quite difficult, and then there was a sort of step back at that point. I think what we saw during that period was a lot of short-term market positioning changing, so particularly in the hedge fund type world. And we have to follow that very closely. We did a market-wide exercise with a whole range of market participants last year to simulate this sort of type of stress event, particularly in highly leveraged markets. And we saw some of that type of activity in April, but it didn't come to a point when there was real stress in the markets. I mean, we were watching it very carefully. I think if I move on to now, what we're now, and I think many people in the market tell me this pretty consistently, and what we're watching is there a sort of shift of longer-term investors going on? And the point I make is, I think going into this over recent years, many international investors have been overweight dollars and overweight US because the US has had a good story over the last 10 years, economically speaking. They were also often unhedged in terms of their exposure to the dollar as a currency because, again, it was a pretty stable situation where that wasn't a bad position. Historically, that had, in recent history, that had been a pretty good position to take. We are seeing that change. So I think we are seeing investors reassessing. This is not a sort of massive de-dollarization. I think it's reassessing that sort of certainly that overweight position, and also to moving to hedge their positions because they're seeing the correlations in markets changing quite rapidly. So those two things, and that will take time to work through because these are longer term investors who obviously move more slowly.
Interesting, thank you. Lord Blackwell.
Thank you, Governor. Can I ask you, can I push you to be a bit more specific on your expectations for inflation? We've been told that the Bank of England model always regresses back to 2% in a period of years. How confident are you that you have the tools to deliver that? And what are the main things you'll be looking at in managing monetary policy over that period?
Well, can I just make the point that when it comes back to 2%, it comes back to 2% because we have an interest rate path in there. So there's a whole set of judgments on interest rates, of course, embedded in there that are part of that bringing it back. So where we are currently, I would describe, we've had obviously rapid disinflation from the problems we had 2 or 3 years ago. Our focus has been on what I call the persistence, the second round persistence effects. How much of that would we see, and to what extent did we need to maintain interest rates and policy in a more restrictive fashion to push down on that persistence? And our approach in the last, since last summer, has been to sort of gradually and carefully lower rates to gradually reduce that restrictiveness of policy as we think we've seen that sort of fairly gradual disinflation take place, but fairly carefully, because frankly, as I'll come on to, some things have not moved as we expected. Now, what we've seen more recently, particularly in the last couple of months, although we were expecting to see it for a little while, is what we tend to call a hump in inflation. So inflation has gone up from around 2.5% to around 3.4%. The causes of that are entirely things that are not really reflecting the balance of supply and demand in the economy. So they're what we tend to call administered prices. So it's a combination of energy prices, which have got the sort of the off-gen process in there, water bills, vehicle excise duty, private school fee, all those things. Now, to be clear, of course, all inflation is inflation, so I'm not trivializing this. What I'm saying is that it doesn't tell us about the underlying state of the economy, which I'll come back to. So the question then is, of course, is how long is it going to take to pull that out? Obviously, it's an annual calculation, and are we once again going to see any second round effects from that? And what stance of policy do we need to maintain to offset that? And so the decision for us, and this is where I come back to the point I made to the chair's question earlier about how much weight we put on domestic considerations versus sort of global considerations. For me, the domestic considerations are much more important. Is what's the context at the moment, and the backdrop, if you like, of that to that question of how quickly is this hump going to come off and we're going to go back to target. And this is where you'll get a range of views on the committee. My own view is that I think we are starting to see softening of the labour market, and that's a message I get when I go around the country talking to firms, but I do quite a lot of. However, pay increases are still well above a level consistent with the target. However, I get the message pretty consistently they are coming off. Our regional agents do an annual survey. They did it earlier this year, and the survey said, no, they are going to come off. And I think so far the evidence suggests that picture is in place. You then get, obviously, the question, for instance, of the national insurance contribution increase, and how does that get passed through? When we go around, and our agents go around, I go around, my colleagues go around, I always lay out a menu of things that can happen to firms. I say, well, obviously you could raise prices, you can squeeze margins, you can reduce your labour input, you can have wage settlements that are lower than they would otherwise be, you could increase productivity, although that would take some time. And of course, you can actually do all of those because they're not inconsistent, they're not mutually inconsistent. Obviously, it's always a question about whether you're getting a representative sample. I would say anecdotally, in recent weeks and months, I'm hearing more firms telling me they're making adjustments on both of the labour market side, so both quantities and prices. I'm getting that story a bit more than we were at the start of when people were, before it actually came into effect, and people were speculating more on what they would do. So that's sort of contextually the situation where I think we are seeing an economy where there is some slack opening up, and that's why my view is the path of rates is still downwards, but it is going to be very gradual and very careful because, as I say, we've got this hump, we've got to see that come out. But I think that context is very different to the one we had, 3 or 4 years ago, 3 years ago now. So that's sort of, in a sense, what's motivating my decisions. But we have to come back to this, obviously, we always have to come back to it every meeting, but particularly, obviously, with what's going on in the world around us, we have to come back to it.
We have a question coming up on the labour market, so I won't ask more about that. But a lot of people obviously have been interested in the past on the link between money policy, money supply policy, and the growth of money supply.
Yeah.
M2 grew at 3.5% or more over the decade, but slowed down recently. Could you just talk a bit about, what is your preferred measure you look at, what its recent performance has been, and what impact that has?
I think I may have said this last time. My preferred measure is the ratio of M4 to nominal GDP. and as things stand, that is actually is now a bit below. So it's come off quite a lot, and it's a bit below its pre-COVID trend line. And I find that more useful than the sort of month-by-month movements, which can be quite volatile and can have all sorts of stuff going on in there, which, the staff always come up with some explanation of the month-by-month, say something's going on in the sort of some bit of the non-financial world. So I find that ratio a more helpful sort of, in a sense, backdrop to reading the money supply side of things.
And it's recent, you say it's about the same level as it was?
It's come off a bit. It's come off, and it's a bit below the pre. So if you look through, put COVID to one side. If you look back to the trend line pre-COVID up to 2019 and extrapolate that, it's below that trend line, a bit below, not a lot, but a bit below it, and falling slightly.
What weight does that have in any of your thinking?
It does have weight. It's another factor that I take into consideration because it's another read, I think, on the underlying sort of, in a sense, condition of the economy and the underlying sort of tightness of conditions in the economy. So no, it does have a weight in my reading, yes.
Thank you.
Thank you. Lord Burns.
Thank you very much. Good afternoon, Governor. I could just press on a little bit further from what Norman has been saying and onto the issue about possible path of interest rates. In the most recent minutes, a phrase that are used a lot is the present restrictive stance.
Yes.
How is the word restrictive in this sense measured? Is this something to do with where real interest rates are relative to the expected growth rate of the economy?
Yes.
Is it what you think is the level that will reduce the growth of nominal GDP? Is it informed by the money to GDP? The phrase crops up a great deal, and it's it's as if it was the most obvious thing in the world.
Well, it's important. I mean, obviously, it is important.
I know,
because it's an assessment of the impact of monetary policy, which going back to
that's the effect of it. So
Lord Blackwell's question is obviously important in terms of what effect policy is having. I would sort of divide it. There's many ways you can get at this question, but let me sort of lay out two, which are, in a sense, not quite normally used, and tell you why I prefer one of them. The one I'm not so keen on is to say what's the level of so-called R star, where R star is the equilibrium neutral interest rate, and then sort of where are we relative to R star. I mean, the problem with it is, I mean, obviously there's a whole range of so-called star variables, which are the sort of, like the equilibrium. So you can have obviously equilibrium unemployment, you can have equilibrium output, and so on. The problem is that, totally with R star, I mean, if you do any estimation of R star, there is quite a big error band around it. And it is, of course, also dependent upon sort of prevailing conditions. So I'm not a great fan of this. There's some sort of permanent or long-term measure of R star, and let's assess where we are. And there's also, going back to what I've just said, there's also a division between what I call long-term and short-term measures of R star, because the short-term one is more cyclical, the long-term one is more structural. So which one are you sort of actually going for? So I don't find that so helpful. I think, so what we do and what our staff do is a lot of work on what I call the monetary transmission mechanism to assess what is the impact of the level of interest rates on that transmission mechanism. So they spend a lot of time, for instance, looking at things like the mortgage market, things like corporate borrowing. What effect is the path of interest rates having? And moreover, what effect do we think it's going to have looking forwards? And that's important because take the mortgage market as the most obvious case. Of course, it's changed structurally a lot over the last 10, 20 years to the system where we predominantly mortgages are now sort of 5 to 7 year fixed term. So again, you've got a very different path of resetting people's mortgage costs. So the staff do a lot of assessment of therefore of how are the past interest rate rises passing through, what's still to come. What is the sort of profile of the adjustment of people's mortgage costs over the coming years? Where, of course, some will be going up and some will be coming down, depending on the length, when they last reset and what the term is. And they add all of that up, and that's where I get the sort of, policy is restrictive currently, and we try to sort of gauge how restrictive it is. That's my preferred way of looking at it.
This month, there were 3 members who voted for lower interest rates. One has systematically voted for rates below the the majority. The other two have from time to time voted for lower rates than the majority. I mean, is there any way you can describe what the significant things are that divide you?
So I think, actually, if you don't mind, I'll look across, because we obviously, if you go back to the previous meeting, we had people voting the other way on the upside. So I think, if we go back to the labour market for a moment, I think there is a range of views on the committee as to how much the labour market has adjusted. There are views, I mean, and Hugh Pill has set this out very sort of cogently in a number of speeches. I mean, he's asked the question, have we seen a structural change in the labour market sort of post-COVID, which is making the labour market more inflexible? And going back to my point about star variables, I think you'd then say, has that raised to the sort of the equilibrium level of unemployment? Now, you raised the question about those on the other side. I think they would take the opposite view, which is I think they would say, I think, you know, Swati Dhingra, Alan Taylor and Dave Ramsden now would say probably they feel they've seen more adjustments in the downward direction. They're more confident that we're on the sort of on the downside of that, and so they felt more confident to vote for a cut. So it's a combination of that sort of, you know, are there sort of structural rigidities in the labour market? That feeds through into the so-called equilibrium variables. I think the second thing I would say is, and I think this is a reasonable sort of, again, a reasonable range of views. I think there are probably also members of the committee who are saying, look, we're beginning to see that the labour market is adjusting, but is that going to be passed through to inflation? So to use the technical term for a moment, sometimes they say, is this a tale of two Phillips curves, that the wage Phillips curve is adjusting? We haven't yet seen the evidence for the inflation Phillips curve. Now, counter to that is, well, you wouldn't necessarily expect to, because actually one will lead the other. And so I wouldn't read too much into that. But that's a debate on the committee, which, by the way, is perfectly healthy in my view.
Yes, I'm sure. The other phrase that caught my attention was monetary policy is not on a preset path.
Yes.
Is this about timing, or also about direction, or is it just a hedge against the fact that, as you discussed at the outset, that there may be many surprises that are around the corner?
Well, is it? Yes. I mean,
we just want to wait and see how they play out.
Yes, it's another way of expressing the term careful and gradual, or gradual and careful. That you know, we don't want to give the impression that, you know, there is a preset path, because the uncertainty level is so high that I think that would be quite a.
You do hint that, in a sense, you do hint some expectation that we are on a downward path as we.
Well, I've been very clear that I think the path is downward, in my view, and will continue to be so. But you know, I mean, I would never, as you can imagine, give a prediction about what the next meeting will do anyway. But I'm also, in these circumstances, we are particularly sort of careful about what we say on that front, because the world is just so uncertain.
Thank you very much. Lord Liddell.
Could I ask you about how you think Britain's performing relative to other countries? I mean, we successive chancellors have at various points said, oh, we're doing very well on the basis of a quarter's figures, and then it hasn't looked so good. I mean, where would you say we are relative to the United States, Eurozone, principal European countries?
I'll give you a more sort of immediate view and a long-term view, because I think they're both important. On the immediate view, we've emphasised some time that although, you know, we had a pickup in growth in the first quarter, which is, by the way, welcome, obviously, we were quite concerned that underlying growth was not showing the same pattern. And I say that for a few reasons. One, because we're not getting the same reads out of the business surveys. The business surveys were not giving that read. Actually, they were giving a more cautious read. Secondly, looking at what I call sort of two key components of demand in the economy. Start with consumption, and then go on to business investment. So the story with consumption, I would say, really is that for over 2 years now, we've had a positive increase in real household incomes as we've come out of the inflation period, and wage increases have stayed higher. Interestingly, that has not come through to household consumption in the way that sort of models based on history would tell you you might expect it to. That's another way of saying that the saving rate is high in this country at the moment. It is high by historical standards. And of course the question then is why is it high and what do we expect it to do in the future? Now, on the why, because there's a survey done periodically, I think it certainly is a reflection of people rebuilding the real value of their savings after the inflation experience. And the second one is that, going back to Lord Burns's question, policy is restrictive and therefore interest rates are higher and therefore that's more attractive. What people don't say, by the way, is something that if you go back in time at various points in the past they have said, which is that they're doing it for fear of losing their jobs. They're not saying that at the moment, by the way. But the point is that consumption is weak relative to that underlying pattern. And the question really we face is, what do we think is going to cause that to change? I think you would expect it to change at some point. You don't tend to have high saving rates going on sort of forever, but it's a judgment. Business investment, I think, brings us back to the opening question on uncertainty in the world. I mean, there is a reasonably well-established sort of relationship in economics between uncertainty and investment, in the sense that because investment is typically a once-off, irreversible decision that firms have to make, in the face of increased uncertainty, the option to wait becomes more attractive. And certainly when I go around the country talking to firms, as I do a lot, I hear that a lot at the moment, that they are pausing investment decisions because of the level of uncertainty that is around. And that, again, I think the trade tariff issue plays into that. So that's the shorter term position. Longer term, and this is interesting, you asked about comparisons, because we also have to judge, I've just talked about demand in the economy, is it demand or is it supply? Now, let's come to supply, and that's where the longer term helps. And the UK is really not that different from many other economies here, that if you go back in time, if you go back before the financial crisis, the typical growth rate of potential growth in this country was about 2.5% a year. Since the financial crisis, it's been about 1 to 1.5. That pattern is not unusual, by the way, to your point about comparisons. The US is rather the outlier there, of having stronger potential growth. When you look at the two things that make up potential growth, which is growth of the labour supply and productivity, that decline is much more productivity than it is labour supply. And you can link productivity back to investment. The UK has had a weak investment story for some time. So there is an underlying story of weak potential growth here. So you see it in other countries, though. The UK isn't unusual in this respect. There is an underlying story of weak investment. And I think there's a very important question which we may come on to about, what do we need to do and what will change that underlying story? Now, to finish, when we obviously take monetary policy decisions, we have to sort of, in a sense, assess the balance between to what extent is it weak demand and to what extent is it weak supply and weak demand, because they have different implications for inflation.
And on the international comparisons, I mean, for instance, do you think that obviously Germany has done very badly in the recent period, but would you expect Germany to recover strongly in the coming years?
Well, I think Germany has a structural story in Germany which is weaker again. I think, because the interesting question in Germany now is that they have announced a very big change in the stance of fiscal policy in Germany, and this obviously is primarily related to defence spending. And the big question now is to what extent that's going to feed through and actually change this position on supply side of the economy. It could do, certainly could do.
Thank you, Lord Razzle.
Thank you, Governor. I was obviously tempted to ask you about quantitative easing, but I think you've seen off Richard Tice of reform on that topic.
I wasn't going to say. I've written. I hope a full answer to his letter. Let me put it that way. It's a good. And by the way, it's an important issue as well.
Yes, I know. So I'll ask you about quantitative tightening instead. Right. Could you comment on the appropriateness of this in the light of the current economic outlook and the adequacy of reserves in the financial system?
Yes. So take those two questions together. We don't regard quantitative tightening as an active policy tool. Bank rate is the active policy tool. All our staff analysis suggests that we don't think quantitative tightening is having on its own a large impact on market conditions, but we always reassess this, and we're about to start the annual review actually any day now, because that builds up to the announcement we'll make in September. So as we do, we'll go back over that question. And it is going to be more interesting this year, because we've had quite a sort of steepening of the yield curve, but then we've seen that, frankly, in all the major economies. So I don't put that down to quantitative tightening, but I said to the Treasury Select Committee in the House of Commons the other day, we are going to have to look at the interaction of these terms, because it is a slightly new territory, that is. So that's a question we will have to come back to. But we set bank rate after taking everything into consideration, including any impact from quantitative tightening, and that's the way we've done it. And I think that's the appropriate way to do it. The aim of quantitative tightening, of course, I would say, is in two parts. One is that we are bringing the level of reserves in the system down to the level that sort of, if you like, the equilibrium level demanded by banks. We're a bit under 700 billion now. We've come down from, I think, about 970 to a bit under 700. Now, we don't know, by the way, again, it's like another of these star variables. We don't know what the equilibrium level of reserves is, but we ask the banks regularly. We have a range, and the top end of that range is about 550. So, yeah, we're about 120, 130 off that at the moment, if that's the case, at the top end. But I'm sounding overly precise there. The second leg of quantitative tightening, which I laid out in a speech I gave at the LSE last year, actually, is then to continue to, in a sense, change the Bank of England's balance sheet once we get to that equilibrium level of reserve, so that the assets on the other side from the reserve accounts, frankly, that we transfer the interest rate risk out into the market, not on our balance sheet and not on the public balance sheet. So that will be the objective thereafter, because I don't think it's appropriate to have that on our balance sheet going forwards. So with reserves, I mean, I've as you said, I've gone into this question extensively in the letter to Richard Tice, and my point is this: we're moving to a demand-driven reserve system. The main reason for those reserves is financial stability, not monetary policy. We could run the system with quite a low level of reserves for monetary policy, because we did it for about 2 years before the financial crisis. But financial stability is a different story, and reserves are the ultimate form of cash liquidity. However, the banks have choices, because actually what we set for them is what's called high-quality liquid assets. So they have to have a certain stock of high-quality liquid assets to match their deposits. Reserves are one form of those, but gilts, other forms of bonds are others, and they can choose what they hold. And the point I made to Richard Tice is, if you change the pricing of those assets, then of course they will make different choices. So, ultimately, if we don't remunerate the reserves, there won't be any ultimately, other than the minimum we'd have to have for monetary policy purposes. Moreover, as I also said to him, frankly, bank profits are obviously a judgmental matter, but I've made the point that we remunerate both sides. Both sides of our balance sheet are remunerated, so we're not making a loss on those activities. It's a pass-through, and we use that to essentially anchor anchor bank rate. For the purposes of, back to Lord Burns's question, for the purposes of monetary policy transmission. So that's neutral in that sense. Going forwards, I think this is a sensible system. What it means for the banks is that they are now returning to a point, a long time after the financial crisis, where they are earning their cost of capital. That's important for the banks, because that's essentially what the market expects quite reasonably. And you can see that because their price-to-book ratios are now just above unity, or a bit above unity, which is essentially, if they're below unity, something's wrong. Either they've got very bad balance sheets, or there's something structurally wrong in the system.
Just two quick follow-up questions. Sounds as though you agree with the FT that the reserve landing zone on QT is likely to be arrived at quite quickly. And secondly, do you agree with your colleague Catherine Mann that there's no obvious answer to the right place at which balance sheet sizes should be dealt with?
Well, I think it is quite possible, if this estimate that we get from the system, the banking system, is sort of near, then we'll get there some point, sort of second half of next year, probably. By the way, it's not just determined by quantitative tightening. We've got another thing going on that during COVID we advanced something called the TFSME, the funding for small, medium-sized firms that for support banks lending to small and medium-sized firms. That's running off, and so that's reducing reserves as well.
You have an idea of the preferred minimum rate of reserves?
Well, as I said, the range has an upper end of somewhere around about 550 billion. So if that's right, then we'll get there in the second half of next year on current trends. So on Catherine's point, look, we don't have a preferred number. What I do have is a system where, so we've got enough reserves for monetary policy. That's pretty small. That the system is maintaining sufficient reserves to achieve financial stability. That's the, and I do think, I do prefer in that system that amongst this stock of high quality liquid assets that they do maintain a decent stock of reserves within that, because it is the most liquid form of asset if they face liquidity pressures. For the others, they have to come to us and do sort of emergency operations to liquefy it.
Thank
Or
you.
go into the market to do it.
Lord Lonsbury.
Good afternoon, Governor. Can we focus now on the state of the UK labour market? I think you mentioned earlier on, in response to Lord Burns's question, there was a range of views within the MPC on labour market dynamics. And to what degree is the current state of the labour market a source of uncertainty in terms of policy formulation? We have unemployment that is ticking up. Vacancies continue to be very subdued. I think they're
Falling back.
36 months consecutively have fallen. And lastly, we've had some quite alarming data, which is subject to revision, I'm sure, on payroll employees from HMRC, suggesting a fall of over 100,000 in the month of May alone. So my question really is, how much agreement is there on the MPC regarding wage dynamics, which the particular variables are getting the focus of the bank?
Yeah. Just on your point about that HMRC data, I mean, you're right, it does come with a big health warning from HMRC written up. So it's useful data, but always with that health warning about the immediate month ahead, because it does get
I've got a
analysed.
following question.
Yeah.
I'm not going to steal Baroness.
But looking more broadly, no, it's important. I think the backdrop to this is, as I think I mentioned earlier, that clearly, well, two things. I think the labour market is softening. Pay, as set out in the AWE survey, has been at levels well above levels consistent with the inflation target. We are beginning to see that coming off. Our agents who do a survey every year, early on in the year, said they thought settlements this year would be around about 3.7% on average when they talked to firms. That was down from 5.4 last year. My judgment at the moment is that is basically, that number is intact, in the sense that I think we are seeing settlements coming down into that sort of territory. But because the AWE is more of a lagging number, it's not, it is coming off, but it's not there yet. So there is uncertainty. And as I said, some of my colleagues, I think, are more concerned that they're not yet convinced that we're not seeing structural issues in the labour market. The other thing I'd say is, I mean, you mentioned unemployment, and this is important. The challenge we have there is that I think the story now is, the bigger part of the story is now in inactivity rather than unemployment. So just to be clear, somebody who's unemployed hasn't got a job and is searching for one. Somebody who's inactive hasn't got a job and isn't searching for one. And inactivity went up during COVID. Now, that was true for many economies. On the face of it, it hasn't come down in the UK. But here we do get into the problems of the labour force survey. Because we can proxy unemployment, as you were saying, from other sources. So our staff would say, look, we can give you a pretty good read of unemployment using other sources other than the labour force survey. You can't do that really with inactivity. The labour force survey is really the source of inactivity data. And so there is a question there. I think there's also a question as to whether we've seen some structural shift of people, there are now more people inactive than unemployed relative to what you might have seen in the past. I think that's a question, frankly. So inactivity is coming down as measured, but it hasn't come down as much as in other countries. I think there are some pretty concerning aspects of it in a broader public policy sense, not really for me, but I think the fact that there are more young people reported as inactive is concerning. I mean, it is concerning. Obviously, from our point of view, the question is what does that tell us about the labour supply going forwards? Does it mean that we've actually got a smaller pool of labour that is available to and seeking work? Or could we see people coming out of inactivity, moving back into the pool, seeking work? That's a difficult judgment to really call at the moment. And
following up on economic inactivity, the current rate, I believe, is 9.2 million, which is a 300,000 improvement, it's a drop from 9.5 million a year ago. Yeah. How does this number overall shape your thinking about the labour market and potential growth? Do you expect this number to increase or decrease looking ahead?
Well, so of course the long run backdrop to this is that we've got a population that is on average ageing. Now, of course, by the way, the UK's, this is pretty typical of it is typical of industrialised economies, so there's nothing particularly unusual about the UK in this respect, but that's the backdrop to the point about labour supply. By the way, I do have to stress the word average because I've said this in the past and I've had angry emails from people saying I'm getting older and you're insulting me. I'm not at all. This is an average point. It's the point about participation in the labour force as people get older. And clearly different occupations have very different profiles as well. So House of Lords, of course, is an outstanding example. But I mean, this is an important consideration as to looking forwards, obviously, and from the point of view of potential growth, given the point I made earlier about there are two sources of potential growth. What is the long-run, longer-term labour supply? Because obviously, I'm afraid the pattern of the population on average ageing obviously is set in the sense that it doesn't move quickly, and that's a very long-term variable which doesn't get moved much at all.
Thank you. Lord Davis.
Continuing on that theme of the employment market, it's interesting that you discussed the whole issue of the labour market without mentioning immigration, when we've had a situation where, very roughly, we've had 500,000 extra workers coming into the country over a relatively short period.
Yes.
But the labour market, in terms of levels of employment and pay increases, doesn't seem to have been impacted at all by something which is much discussed about the impact it has on employment and wages. But from what you have said, the implication is that it's had no impact at all.
Well, perhaps I shouldn't quite say that. In aggregate terms, it isn't as big as movements in the domestic population and the domestic labour force. So if you look at the aggregate movements, the bigger impacts come from movements in the domestic labour force. So, look, we do obviously look at the supply side of the economy very frequently, and we do obviously take the immigration numbers. We take the numbers that the ONS give us. The OBR also give us a view on it as well, but we take the numbers the ONS give us. We're not generating our own numbers. We're not making assumptions about what policies towards immigration are going to be. All I would say is I think obviously there is an economic side to that story, and it is a factor to consider in the overall stance of sort of approach towards it. But immigration on its own is not as big an impact on labour supply as the domestic labour force.
And wages?
Well, likewise, it isn't as big an impact as movements in the domestic labour supply.
Baroness Liddell.
Thank you, Governor. I am concerned about labour market statistics. We know that there have been recent problems with ONS and they've sought to overcome them. To what extent do quality concerns constitute a problem for the bank in coming to conclusions on forecasts and policy? Because this isn't a new problem. This is a problem that's been around for a very long time. And what can be done to fix it?
I think, look, we've obviously expressed our concerns, and we share your view in that sense. I think there are two things I would draw out. First of all, it is obviously very important that the work is done to complete the to rebuild of the labour force statistics, and also obviously also in other areas of statistics, because currently the producer price statistics are suspended. We had an unfortunate error in the consumer price index back in April to do with vehicle excise duty. And it is critical from our point of view that these issues are addressed. With the labour force survey, a good part of it obviously is participation. They have increased the participation rate, but it is not back to pre-COVID levels. And the problem in there is to what extent is it a representative sample. And this is critical to some of the issues we've just been discussing, such as what are the sort of the trends in participation and what's causing these trends in participation. They have a plan to make further improvements in it, and we're very strongly encouraging that plan is obviously got on with and put in place. And that when you look at things like the CPI issue they had, that the quality control mechanisms are in there, because that was to do, as I understand it, with with a spreadsheet that had a number in there for the number of vehicles that were on one particular level of fuel duty relative to others, which was wrong. The second thing, and I think this is a thing that affects all statistical authorities, is that there are things going. I mean, there are always things going on that affect how the statistics are calculated. I think there is quite a lot going on at the moment. So two I would pick out at the moment. One is so-called intangibles, how we sort of measure intangibles, so in activity and in investment. So I know the ONS, for instance, are doing work where they're trying to capture for the measure of GDP and activity the value of data as a level of activity. And it is valuable because we're seeing far more of this with things like AI and so on. And I know that the ONS are working hard to try and come up with a measure of that. And that's the right thing to do, because that's a reflection of the economy sort of changing around us. I think another area that I focus on quite a lot, going back to consumer price inflation, is the so-called dynamic pricing that goes on. And there is more volatility now in the services, one part of services prices. So if you ever now book a flight or a hotel or room or a concert or anything, you can find quite different prices, very different prices from day to day. I don't, by the way, I'm not saying the series is wrong, but I think there's a question about how you capture again the fact that these prices a part of it can vary rapidly from day to day. They obviously, quite rightly, they take the sample every month on a certain day at places across the country, and obviously how you control for these developments is another important thing to think about. That's not because things are wrong, it's how the economy is changing.
You sound frustrated by it. Are you convinced by the statistics that you're having to work with? And what country does it better than we do?
Well, look, we have been frustrated by the labour force survey because it is, as you probably detect from everything I've said this afternoon, it's a very important part of the underlying story of monetary policy. So it is frustrating. I think for many of these things, many statistical agencies are facing the same issue. I still find it hard to quite understand why the participation rate in this country is lower. During COVID, we just don't answer the phone, particularly when the ONS call us up. But we don't answer the phone. Now I don't know why I can't understand why the British are any worse or any different to anybody else in this respect. Actually, it doesn't really. But that was a problem, particularly during the COVID period. So it is important. I mean, we obviously have our staff go over the data, and as I was saying earlier, we look for a lot of alternative sources to, in a sense, validate and cross-check data, and that's the right thing to do, and we'll go on doing that because it's the right thing to do, and we'll go on doing that.
Does anybody do it better than we do in the UK?
I'm not an expert on other countries' statistical agencies, to be honest, so I'm not that well qualified to answer that question, to be honest. I have not spent a lot of time looking at how other countries do it in that sense. I think there are some methodological differences. There's a lot of common ground. One area that I have highlighted before, because I think it is interesting and it's actually in some ways relevant to other areas of policy, is this whole question about output in the public sector and therefore productivity, which does feed through to total productivity. So we saw this during COVID. I mean, the health service is the best example of this. The UK, I think the ONS would say the UK is actually ahead because they actually seek to measure actual things. They measure things that the health service does. So, procedures, operations, trips to the dentist, what have you. I think a lot of other countries still basically take the amount of spending, deflate it, and get a total aggregate output measure. Well, the problem during COVID, of course, was that the stuff they measured stopped happening. Yeah. So, I remember Rishi Sunak and I, when he was chancellor, saying this is just what the hell's going on, because health service output fell off a cliff, but it was quite clear the NHS was, was absolutely totally at it. I mean, can't criticise them for not working hard. They were really working hard, and that was a product of the way it was measured. Now, to say in normal times, it may be a better way of measuring it. What we have had, though, is quite a big fall-off in productivity in the health service. So you look at productivity in the health sector relative to end of 2019, pre-COVID, it's come down a lot. Now, the question is, what do you read into that? Is that about measurement, or is it about something real? I don't know.
Thank you.
Ernest Wolf had a quick follow-up.
Yes, it is a quick follow-up. It's actually a very quick observation and a very quick follow-up. The observation is that actually in some countries you are legally obliged to answer some surveys. This probably doesn't get you 100% response rates, but it does get you rather higher ones. But the more general question is actually about the extent to which we have become over-occupied with apparently detailed and precise survey data, which are being updated constantly. If you went back sort of 40 or 50 years, there was probably less of it. And I wonder if you have any observations about whether you feel that on the whole where we are now is way better than where we were 40 or 50 years ago, or whether we may have become over-dependent on the supposedly detailed updates of supposedly highly accurate quantitative data.
That's a really good question. Well, I'll give you one example. Let's go back to unemployment. We managed to raise interest rates from basically nothing to 5% and disinflate the economy without having a big increase in unemployment. And I think, well, that's good. But if you go back to this question about inactivity, then you say, well, yeah, but what is going on really here? And therefore I don't go around saying that because I'm quite hesitant about this. And that's, I think, an argument of saying, look, we do need to try and use the data to understand the story as best we can, actually.
Thank you. Lord Pettigrew.
Governor, good afternoon. The question I have is really about productivity again, and productivity is clearly an issue for the whole economy. It's clearly too low. And my question is really observations on 2 points. The first one is the disparity between, I would say, more optimistic productivity forecasts from the OBR and those of the Bank of England, yes. And that as it relates in terms of all the decisions you have to take, and also the fiscal side of things for the government. And the second is really how do you think about the methodology for the Bank of England? How do you think about productivity forecasts, long range forecasts?
Well, first of all, I mean, obviously the OBR should speak for themselves, but I'll have a go. I should say, by the way, I think I'm right in saying for the next 2 years, just the next 2 years, our numbers, our growth rates in productivity are pretty similar, about 0.7, 0.8, I think. But you're right, though, that actually looked at sort of slightly further out, we're a bit different. I think the way I would interpret it is that I think I'm going to sort of speak very carefully because it's really for the OBR to speak for themselves. I think they have more of a reversion of a bit more of a reversion of productivity growth to its pre-financial crisis pattern than we do. And I think the question for me there is a really important one, which is what caused this fall off in productivity post-financial crisis? Is it the financial crisis or is it something else? I think if you were to sort of take the sort of what I sort of loosely call the OBR story, I think you'd more say it was a financial crisis and that effect will wear off. I think I'm a bit sceptical about that, whether the financial crisis. I mean, there's no question the financial crisis had a damaging effect in the short run. Whether it's had a longer run damaging effect, I'm not so sure. And the reason is this: that I think there was a good argument that over history, longer term shifts in productivity are driven by technological innovation, and particularly by what tends to get called general purpose technology innovation. So, the steam engine, electricity, the internet, ICT, these are the things that move the dial. If you look at the longer term, in most of the major economies, post-Second World War productivity growth peaked around 1973-4 and then gradually came off. But then there was a reversion between about 95 and 2005, which was the sort of internet ICT period. But in terms of contribution to growth, that's sort of worn off. That's a long way of saying I'm rather more in the sort of, I think it's more sort of underlying technological innovation type drivers. And therefore, if we're going to see a pickup in underlying productivity growth, the question is, what's the next general purpose technology innovation? Well, best guess it's AI, actually, in the sense of what's the most promising thing we have on the horizon at the moment, it's AI. Now, the other thing I would say is that going back to these sort of past general purpose technology innovations, they do take quite a long time to come through into productivity data. So I'm not saying, people said it's about 40 years between Edison first wiring something up and electricity coming through in US productivity. It won't be that long. I mean, don't get me wrong, that's, we're in a different world now. But they tend to take somewhat long because we're all, and I see it ourselves. I mean, we're all essentially experimenting with AI at the moment, and the expectation we'll get something from it. I think we will. So it's a long way of answering. I think one way you could describe the difference is that I think our story is more driven by, that sort of more sort of underlying sort of innovation type story. OBR will speak for themselves, obviously, but maybe they're more sort of saying the financial crisis effect will wear off.
Thank you.
Lord Blackwell had a follow-up.
Governor, do you think there's anything in the argument that the scale of immigration has had an impact on productivity? And productivity is an average number. If we take in a high volume of relatively low-wage labour, the argument could be that disincentivises investment that would otherwise drive up productivity. It also fills a number of low-wage jobs, such as delivering Amazon parcels that didn't exist before. The highest growth in productivity, I think, in British history followed the Black Death when the population halved. I'm not suggesting that that's the remedy, but how do you take account of immigration as an impact on productivity?
We do. We do. I don't think we can tell you any sort of precise story on that. That would be for other parts of, I think, government to assess that. So we look at the overall level. But I think I would not drive that story in terms of what I call sort of particular supply of particular sorts of labour, as much as what's the demand for labour, and as you say, I mean, what do these technological innovations mean in terms of demand for labour? So Amazon delivery would be a good example of it. I don't subscribe to the view that technological change destroys jobs in a sort of mass unemployment sense. I don't think it's done that over history. But it does cause, obviously, the need. It does cause a change of employment mix. Quite clearly, some jobs disappear, some are created. It creates a demand, for training and investment in the skills of the labour force. I mean, the other thing I'd say, I go around the country a lot, and I do go to employers. I been to a couple recently who said, "Look, we just could not get the skills we need. We've had to go abroad." To find the people, that have the skills to expand our business. I mean, that's you do hear that.
Lord Turnbull.
I asked you some question about the appetite for UK debt.
Yes.
When Robert Stephen retired, he gave us a very bullish account. He said it's not surprising given he'd sold about 2 trillion over his career.
Yes.
But he said, if we're looking forward, are there any structural changes? You get to a point where I think you're indicating not far off. We might be at a point where the bank is neither a net buyer or a net seller of debt. Are there any of these structural changes either for or against the appetite for debt, given that the projections have it, OBR have it staying quite high for quite long, and not many people really bet very much that it would turn out better than that?
No, it's really interesting. So I think we've seen two quite big structural changes. And I don't think, by the way, UK government debt markets are unusual in this respect. So the first one is that there has been a change in the mix of buyers. So obviously we're not buying, and the LDI pension funds, this is particularly at the longer end actually, the LDI pension fund sector isn't buying in the way that it used to buy. I think we are seeing more buying from a combination of actually bank treasuries, going back to the discussion we were having about the mix of high quality liquid assets earlier in this session. We're seeing more overseas investors buying on average, and we're seeing more hedge fund activity, and I'll come back to that because that's the second point I was going to make. So there is a change in the mix of buyers. Our market intelligence staff would say to me that one of the consequences is that you've got a mix of buyers now who are more sensitive to relative yields in the market in terms of their investment activity. So you've got a somewhat different mix of buyers in terms of their sensitivity to yields. The second point is this point particularly about hedge funds. So I think all the major government debt markets have seen a very big change over the last decade. I made a speech on this earlier in the year. So that what you've seen is a big change from and this is particularly in the primary auction market, but it carries on from there. A decade ago, what I would call the bank dealers were the main buyers in that market. Today, and they say the gilt market is no different from US Treasury market or indeed other major government debt markets. It's actually largely hedge funds who are buyers. You've also got some non-bank dealers now in that market who are sort of crossing over between those two landscapes. So the pattern of buying and activity is very different. And the point I made in the speech, and this is something going back to volatility we saw in April, we see somewhat more of is that there is a lot more leverage in government debt markets now than there used to be, based on that pattern of buyers. So things like the basis trade, where they're trading between cash and futures markets. The profile of activity in government debt markets has changed hugely in the last decade.
Now, if we globalise that, lots of other governments have projections of borrowing staying very high for very long. Is that a problem for us? There is the old story about you hunters chased by a lion. You don't have to run faster than the lion, you just have to run faster than the other guy. That so long as we can stay not being an outlier and maintain our position.
So it's very interesting actually. Start by looking at the UK for a moment, just the UK. If you look at the pattern of the UK, again, since the financial crisis, what we've seen actually is quite restrained borrowing and debt levels in both the household sector and the business sector. Against that, different stories, you say, in the government debt market, in the government sector. So we've seen a change in the pattern of overall indebtedness in the economy, because I get asked quite often, well, you've put interest rates up from nothing to 5%. You must be very worried about the impact of that on leverage and indebtedness in the household and business sector. And I said, well, I can understand why you asked that question, because I would ask that question. But actually, when you look at the numbers, they're actually not that. They're not at all, concerning in the aggregate. And by the way, there will always be people, obviously, who are badly affected by it, don't get me wrong, but in aggregate. So some people sometimes call that that's quite a Ricardian outcome in terms of the balance of debt. I'm not sure, I don't have the figures in my head for other countries, whether you're seeing the same thing in other countries. That's an interesting question. One, I think I've said to my colleagues, we do need to look more into as to whether we're seeing the same pattern in other countries. Because there is a shift towards sovereign debt. There's no question about that globally. There is a shift towards sovereign. Now, I think part of the problem there, or part of the issue there, is that there are, at least to my mind, three structural headwinds that we're facing now in that world. One is, going back to what we were saying earlier about the impact of an ageing population. Two is obviously the turnaround in what tends to be called the post-Cold War defence dividend in terms of public spending. And the third one is what we do to adjust to climate change. And you put all three of those together, those are big headwinds again, in terms of demands on public indebtedness.
You mentioned sovereign debt. Does that mean we've got more competitors for selling government debt than we used to have?
Yes, because if you look at indebtedness numbers across the major economies, they're generally running higher. Of course, the US is the US is very prominent in that sense. Now, I think, by the way, that's an interesting, if you don't mind saying, that's a really interesting question, because it also gets you to this question about the sort of the dollar as a reserve currency, because in many ways I think the meaning of that term these days is that US Treasuries are the safe asset in the system, and there has been demand for US Treasuries as a safe asset, and so that is a very interesting question as to it's a slightly chicken and egg question, but what's driving this outcome? But yeah, I mean that's a very big shift. Yes.
Just a quick. Hedge funds are the primary market for this debt.
Increasingly so, yes.
Yep. They're also making a lot of money. From whom are they getting that money? Are they making it at the government's expense, or are there other counterparties out there who, for whatever reason, are happy to give money to hedge funds?
If you look at something like the so-called basis trade, where they're trading very fine margins between cash and futures prices, they are having to do. This is where the leverage is so big, because they're having to do very large trades to earn very fine, to earn what looks in cash terms a large return, but the margin is actually very fine. What that means is the leverage is very big. Now, not a question I don't think I really could answer easily as to, because it's a good one, which is, well, in the counterfactual, where would those returns go if they weren't doing that? That's a hard question to answer. Would they go into the banking system? Would they go somewhere else? Good question. I don't know.
Someone must be paying.
Well,
their profits.
You'd have to sort of, in a sense, sort of compute the counterfactual to what would the system look like without that.
And the people who are paying don't know they're paying. It's just
yes, I mean, I don't think
it's like the air we breathe.
Yeah, I don't think we can. Any of us can say, you know what, I can see how much I paid. No, I don't think we can say that.
Baroness Wolf.
Yes, I'd like to ask you a question about the OBR and contextualise it a bit in terms of first where you started, the growing unpredictability of the environment, and secondly, the question that Baroness Little posed about the fact that our data are really not tremendously trustworthy or reliable. And so we've got the OBR, which is making very, very precise predictions and judgments, and has to do that. And these feed into fiscal rules, which then in turn mean that the government sort of suddenly jumps around at the spring statement and cuts something here and cuts something there. And clearly this has some obvious defects as a system, though it may be better than the others. So I had sort of two questions about this. First of all, does this system with the triangle of the OBR, the Treasury and yourselves, how does the impact of the OBR on the government because of fiscal rules in turn impact on the decisions that you are able to make? Is it a serious issue for the bank in terms of its own decisions? And secondly, I wonder if I could invite you to speculate on whether there are any ways we could make the system slightly more acceptable and less likely to create bizarre swerves in order not to break an arbitrary rule.
Well, obviously, look, it's not our area of policy, so I'm going to be very careful what I say, because it obviously really is for the Treasury and the OBR. First of all, I mean, I would say we work very closely with the OBR and with the Treasury. As I've said before, I'm sure we take, we condition our forecasts on announced government policies. Now, what in practice that means, obviously, is the government tells us what the policies are, but actually even more practically, we take the OBRs. I mean, if you take things like fiscal multipliers, for instance, which are important, we don't do them ourselves. We take the OBRs, the fiscal multipliers. So there's quite a decent sort of OBR input in that sense, and we talk to the OBR a lot, work closely with them. So we can understand their thinking behind that. But ultimately, say we take announced government policy as given. And I think that's sensible. I don't think it's sensible for us to start coming up with different views on fiscal policy in that sense. I'm going to be very careful. I think you posed a very, very, very good question about the overall sort of impact of this. I'm going to be very careful in what I say, because it's not for me to start giving judgment on fiscal policy. One thing, I'll say one thing, because it's exactly to what point you made. I mean, I think it's just important to emphasise that this figure of whatever it is currently, 9+ billion, is a 5-year ahead forecast. Now, if we know one thing about forecasts,
Indeed.
it won't be 9 billion. But that's not a helpful thing to say in the sense of, well, fine, thank you very much. So what number do you recommend? All I would say is I think, I would say, there is a danger in over-interpreting a 5-year ahead forecast. What you do about that, I think, is and that's for I think it's not for us, it's for the government. So I don't come out with recommendations on that. But I just caution, because I think sort of having the financial markets marking fiscal policy to market on a daily basis is not a good state of affairs in that sense. And I don't think I'm sort of probably at odds with anybody, particularly around government, in saying that. Solving the problem is harder, obviously. There's not a ready solution to that problem. Some people say, well, if only you had a bigger number than 9, but that comes at a cost, obviously. I mean, that's for the Chancellor, but it comes at a cost. So I'm not prescribing any solution, but I do think we have to be careful about over-interpreting, numbers that are inherently uncertain.
Okay, thank you. Lord Lamont.
Good afternoon, Governor. When you last appeared before this committee, the subject that we asked you about quite at the time was sustainability of UK national debt over the longer term. Would you like, the questions never change, I don't know about the answers, but perhaps you could update us on your views on that?
Well, I think, let me come back to the point I made about these, in a sense, these 3 headwinds. These 3 big headwinds that are running, against certainly all developed countries, if not all countries. So the impact of an ageing population, what that means for the fiscal position. And by the way, both in terms of obviously of the demand on public spending, but also the issue of the labour supply, as we were discussing earlier. The question of, sadly, the question, I say sadly, I was in Ukraine on Friday, so I saw this for real. I mean, the impact of the post-Cold War defence dividend essentially turning round now. And the third one is whatever, is the right approach towards tackling climate change, which again, I leave to others to decide. All of those things are obviously very important. I'm not going to prescribe what should be done about it. I do think that it's important that, I don't want to sound preachy about this, that we do have a proper debate with the public about the implications of all of this and what it means for the evolution of the economy and the evolution of public debt. It's partly going back to Baroness Wolf's question about not being constantly focused on a 9 billion number and saying, look, there are some very big moving parts here, to your question, Lord Lamont, in driving the longer-term sustainability question. And those are very important, much broader public policy questions. They're not for us, I'm afraid, at the Bank of England, but they are broad, big public policy questions.
You say they're not for you at the Bank of England, but I mean, you must be very concerned about it for the longer term. The OBR made not a forecast, but a hypothesis on certain assumptions that in the 70s debt to GDP could get to 270% of GDP, which for anyone to read is highly, highly alarming. I mean, do you think, I know you've made speeches about this, in particular about ageing, if I can roll this into the next question as well, but do you think anyone's listening, or do you think the public are paying any attention to it? I mean, I was very struck by an interview that Charles Goodhart gave. As you know, Charles Goodhart worked at the Bank of England for very many years, highly respected.
Yes.
But I don't think he said anything like this when he was in the Bank of England. He gave an interview to the FT in which he said, referring to ageing, that the costs are going to be enormous. We're in for a fiscal crisis down the road, and we don't know how to solve it. And he went on to say, after he said it was impossible to add to borrowing, taxation was near its limit, he went on to say this: you know that something is unsustainable, but you don't know when the dam will burst. But in macroeconomics, things can go on pretty much as normal, because that's what people have come to expect. And then suddenly something happens. Do you think that's an exaggeration?
I think Charles made a very good, if I remember right, because I was very interested to read it too, I think Charles made a very important point there in emphasising that how important the productivity story is there. Because in terms of what, if you sort of ask the question, what breaks us out of this position? And I think Charles's answer to that, it has to be productivity. And I think he's right. And by the way, that's critically important because if we've got a declining labour supply or a labour supply that isn't rising, at the very least in the way that it has because of this structural factor, then the productivity story becomes even more important, going back to my point about what determines supply side growth. So I think that's critically important. And look, if you don't mind me saying so, I think the fact that this committee is doing an inquiry on this is very welcome. I really, think it's important that all of us find a way to emphasise how important these questions are as a matter of public policy, because otherwise I think we're stuck in this world of sort of managing the sort of which we have to do obviously, managing the sort of the problems of this year and next, rather than saying where's it all going to in the future, because it's critically important, and I think it's critically important that we lay the situation out to be explained.
Thank you. Lord Vergy.
Good afternoon, Governor. You've talked briefly about climate change and headwinds. In early June, the FT wrote that senior Bank of England staff members who resigned from the climate and nature risk supervision roles have complained that the central bank neglected the issues, leaving the UK financial sector underprepared. Can you just comment about that? Where do you think?
Yeah, I mean, I obviously read the article. I think the point was being made was, certainly my approach to it, and I don't apologise for this, is that the government has set us a very clear remit in that respect. I think it's much more applicable to financial stability than it is to monetary policy in the current environment. It's not irrelevant to monetary policy, but it's much more applicable. Climate enters into our considerations as one of the risks to financial stability, and that's how I look at it. It is a risk. There are different views, of course, around the world. I mean, the US administration will probably take a somewhat different view of this. One of the views, I think, embedded in there is a point Mark Carney made in the past, which is this question about the horizon. I mean, what's the horizon over which the financial stability risk crystallises, and how serious it is? But that, for me, it is one of the risks we have to look at. I'm not going to pick it out as a sort of put it up in lights above everything else. It is one of the risks we have to look at it. And if people criticise me for that, I'm going to say, look, I think that is our remit in respect to financial stability.
Lord Blackwell.
Governor, can I just go back briefly to the ageing population question? I mean, this may be a 10 or 20 year problem, and you may not think you'll still be governor in that time, or we may hope.
I definitely won't be, actually.
But if we have, as the forecasts project, an increasing proportion of the population not in the labour market, but their spending power will continue to increase because although there are poor people in retired, there's a lot of asset-rich retirees. And yet the productive capacity of the economy without productivity growth, won't be growing commensurately. Not only does that raise the question of fiscal issues, but doesn't it also raise the question of getting into continued inflation pressure of growing spending relative to
well, it could do, but equally the other argument is the so-called life cycle saving hypothesis, that we all save more as we get older, and that's what underlies one of the arguments, which I know Charles I think has pushed back on. I can understand that, but that's the argument which underpins the view that actually an ageing population is one of the reasons back to Lord Burns's question, I think earlier on, that the neutral rate of interest the long run neutral rate of interest comes down because you get an increase in saving relative to investment demand, and that pushes the real interest rate down. Now, Charles, I think, doesn't agree with that, and I think probably actually both arguments are in play, so I don't disagree with him on that particularly. But it isn't a one-way argument, I think, on this point.
I'm not sure people continue saving once they've retired.
Well, I think the point is that they don't disinvest in the way that the theory would tell you. So I think when that theory, I mean, goes back a long way now. When that theory was originally developed, I think there was a view that people would disinvest sort of almost seamlessly during their retirement, but actually they don't, is the answer. I don't think that is the case.
We can come back in 15 years.
Not with me as governor, I'm afraid you won't. But I have to say this slightly ironically, because I was giving a speech this morning at a conference we've been running on the return to the gold standard in 1925 by Montague Norman, who was governor for 24 years. So those days are over.
And I'm going to ask colleagues if they have any final follow-ups in a second in response to things you said. But I have one myself, if I may, which is going back to the beginning of our discussion, or the first few questions. You gave us your account of your expectations about inflation and rates. But I wondered, in a comparative sense, what you think explains the stubbornness of inflation in this country compared to the United States and the European Union. Maybe that's not the right word for it, but disinflation has certainly been weaker in underlying inflation here. What factors do you think you can point to explain
Well,
that?
I think one factor is how, it does look as if, sort of going back over recent years, we've had a tighter labour market. So this comes back to this point about inactivity as to exactly what the labour market position was. But look, I would say this, going back to the 2021 period particularly. I would say to people, what was hardest to read at that period was what was going to be the impact on the labour market of the ending of the furlough scheme. Almost all forecasters were expecting it to lead to an increase in unemployment, and it didn't. So the labour market looks like it was much tighter during that, coming out of that period, and the UK may well have had a tighter labour market, and it may be part of the story about higher levels of inactivity. Now, so we now think we're seeing slack opening up. We think we are. That may be part of the story.
Thank you. Do any other colleagues have any final follow-up questions?
Can I? No, sorry. You go first.
Please, after you.
Okay. Well, it follows on directly from Lord Wood's question, because it comes back to the labour market and actually the comparisons with other countries. And I know obviously you can't be an expert on every country, but when you discuss the labour market and the inactivity rate, but one of the things which it seems to me we don't pay as much attention to as we should in policy discussions is not simply the tightness, but the degree to which people move jobs, job mobility.
Yes.
And I wondered if that was something that you did pay attention to.
So we do. So one of the helpful things in the last month, but only in the last month, is that another part of the LFS is actually flows in the labour market, and that has been suspended for quite a while. So we've had no flow data, and that is a problem in terms of exactly your question. So we've now got, I think, one reading, and we're now hopefully going to get some more, obviously get a series of them, but we don't quite know how, obviously it goes back to the overall state of the LFS as to how good those readings are, but not having the flow data, so this is flows in and out of employment, inactivity and unemployment, has been a considerable handicap in that sense.
Peter, yeah?
I can't. It's not quite a follow-up, but I can't resist asking you a question about the general environment and the economy and the markets, and where you see what worries you the most in the whole financial system. We've had a few scares, and actually the system has been very robust and very resilient, and regulation clearly has had an impact. But people are concerned about levels of leverage in private credit, in particular. Where would be, in your mind, the areas of maybe unexploded ammunition that could come and haunt us at some point?
I think there are two that are of particular focus for me at the moment, and I do have a rather global perspective, because I'm about to take over as chair of the Global Financial Stability Board, because obviously I don't have enough to do. So anyway, and you've sort of mentioned. I mean, the first one is this whole question, going back to the question Lord Turnbull asked and others asked about debt markets. There's this build-up of leverage, and particularly the build-up of leverage in the non-bank sector. So a lot of our work is focused on that. Not because we're saying it's bad per se, but this question, this is why we did this sort of flow stress test last year about how would it unwind under stress, and are there points of pressure in the system, and if so, what do we do about it? Now, I think it's been interesting, say, in the April period, we saw some of that go on. It wasn't actually in the basis trade, it was actually in asset swaps, actually, particularly. We saw some transmission channels going across markets. Having said that, the system basically stood up. And, obviously, I would say this, wouldn't I? My line on sort of this whole regulatory debate is, look, I'm not going to pretend our rules are perfect, but there isn't a trade-off between financial stability and activity and growth in the economy. And what we saw in April was a period of stress, and we didn't see an underlying financial stability problem. We weren't dealing with banks that were failing, for instance. So that's the first one. The second one you mentioned, which is, look, the whole private credit, private equity world has grown obviously rapidly. I think the question for me there is, it is an opaque world. So I don't want to sort of, in a sense, point the finger and say, there are bad things going on there. I just do not think it is currently visible enough. And therefore it's going to be a focus, both of our work at the Bank of England, but also I hope the Global Financial Stability Board's work, because I think we do need to lift the lid on just whether there are points of pressure in there. It's grown rapidly. It does have to have the light shone on it, I think, in that sense. So those are two that I would pick out at the moment. I mean, if I had to name a third, it would be what are we, it's a completely different bit of landscape. What are we going to see in terms of this growth of so-called stable coins, and particularly now that the US legislation has passed, and what are they going to do?
Well, Davis,
Is it your second point is the same thing as shadow banks as well? There's that whole financial structure which is really outside your purview in many ways.
Well, I mean, you may have better figures than me. I think I'm right in saying, and if I'm wrong, I'll write to you and correct you. I mean, I think in the private credit, private equity world, I think it's around 2 million people in this country are employed by firms owned by private equity projects. So it's not, it's not small in that sense. It's not wrong. Don't get me wrong. I'm not saying it's wrong at all, but it's less visible.
Lord Burns.
Small issue, but I noticed reading the minutes, you had this lovely spreadsheet at the bottom of the minutes, a link to it, which showed the voting patterns on the MPC, more or less going back to the beginning
of time.
MPC. And I just happened, I had 5 minutes to spare, and I was looking down this, and it seemed to me, I would have said on the face of it, the number of minority votes are extremely small, considering the degree of uncertainty that there is in this world, as we've been, saying about the extraordinary things that can happen. I mean, do you think it's the sort of number you would have expected, higher or lower?
Well,
I mean, it gets a lot of attention whenever anybody.
Yes. I mean, it's more than in other monetary policy bodies, I should say.
What happens in other monetary policy bodies?
It's more than in other monetary policy bodies. My approach, because I know we've had this discussion in previous years about groupthink, is that I do think it's important that the essence of the way our system works is that the 9 of us get in a room, we deliberate at some length, as you know, you've been there, and we reach a view, and I want my colleagues to feel they vote their view, but we do have to have an outcome, obviously, and we do get an outcome. So I'm very robust on the fact that I really don't think there is groupthink in the committee. I do get the opposite pushback from people saying, "Will you people just please sort of get together and come up with a single answer?" So this argument goes both ways, frankly. I think it is. I think what we're seeing at the moment is a genuine expression of the views of people on the committee, and the fact that there are different views, as I described earlier, I welcome in the sense that I want different views on the committee, and I want people to feel they can express them, and that you can see that they've done that.
Lord Virgie.
I think I'm right in saying that we have not mentioned China in this whole session.
No, you haven't.
Can you just comment a little bit about long-term debt sustainability with a really changing geopolitical world? You've got Middle East countries that used to be net lenders, now net borrowers. You've got China having to take a really deep geopolitical view. How much impact is that going to have on our debt sustainability in the future?
Well, I think there's a very big and important current question underpinning that, and it's a question about long-term imbalances in the world economy. There will of course be imbalances in the world economy. That's the way development happens, and I think that's very important. Of course, the question is, and it's obviously a question that the US administration has put very firmly on the table. Is this an unsustainable position in terms of China? In particular, there's other parts of the world they also have views on, but particularly China. My own view is that I think that these imbalances are driven predominantly by macroeconomic outcomes. I think there is a level below which you might call the more sort of transactional trade element, which is sort of more the stuff that WTO is responsible for. That has an effect, but far more the dominant factor is underlying macroeconomic conditions. China has had weak domestic demand, household domestic demand for a long time, which has in a sense, supported an investment-heavy, export-heavy development model. What I do think we've got to do is get back to, and I'll be saying more on this when I've written it. We can't have a situation where the multilateral institutional system decays. We have got to get back to tackling these questions in a multilateral setting. Now, the history of that isn't easy. It isn't easy at all when you go back in time. But I don't think that unilateral tariff action is a sustainable solution to this. We've got to have much more of a multilateral understanding. My experience when you put it to the Chinese, as I have done, look, I think you do have an issue with with domestic household demand. I think they don't disagree. I don't think, however, it's very clear what the action is.
And one last question from Lord Lamont.
I wondered if I could go back to the previous question of Lord Vergey about green policies and the policies of Mr. Carney, policies which I was interested to read he's reversing in Canada entirely. But
I want to comment on Canadian politics, please.
No, that's not for us. The government has modified its policy slightly towards North Sea oil and gas with its decisions on Rosebank and Jackdaw, but nonetheless it was a quote stated in a paper on Sunday that there is no UK bank will lend to the North Sea sector today. Is that right? And would you not be profoundly unhappy if that were true?
I don't know, to be honest, and I think that is an issue for the government to take up with banks. I do think that whatever you think about sort of the climate issue, the transition period to net zero is quite a long one, and it does require, obviously, to have a sustainable, what you might call sort of base energy supply level. And I think the question of what investment is needed to support that naturally follows from that. I think you're right on that. So frankly, if there is an issue with banks lending, I would encourage, I think it's really for the government to talk to the banks and say, what do they want to see? I don't think we should be making that policy ourselves. I think it's for the government to decide. Very much, I read the same thing about defence companies, and I'd say the same thing. I think it is for the government to say, look, I think give a steer to the banks to say, this is a big public policy issue. This is what we think should be going on.
Well, Governor, thank you so much. We've taken you across the world, across the policy spectrum. You've been very full in your answers. We really appreciate your time and your candor. And you made one rash forecast today saying that you won't be governor in 25 years. So
I think that's in the legislation, if you don't mind.
I'll hold you to that. And thank you very much. With that, I declare this meeting closed.
Thank you.